Hello everyone, it's Jeffrey Cohen, Chicago Quantum, U.S. Advanced Computing Infrastructures Incorporated, an Illinois corporation dedicated to using math and quantitative sciences to help you. Also very, very interested and involved in quantum computing, although less so over the past year. So let's talk a little bit about what we saw today in the markets. It's been a pretty dry day. The data hasn't told us much, and in fact, markets really haven't moved that much. The war in Ukraine isn't really evolving much, but one piece of news that was interesting was Target. Target released its earnings and had its earnings call. We picked up a great deal from that. The first is if you look at the Q3 Target highlights. Think about the fact that we've been doing business for a year, your Target, right? Target's a pretty big company, lots of stores all over the U.S., slightly more affluent than most in terms of the customers. And I never noticed them to be a relatively like a cheap store. So when we see comp store sales up 3.2%, I think that's interesting. And I see digital sales up effectively 0, and I think that's interesting because we're dealing with inflation of maybe 8%. So in fact, people are struggling and they're buying less at the stores. Okay? GAAP earnings per share is down half from a year ago. So that makes sense, right? The big context is profits down half. The second thing they talked about was October. So August, September, October. August, September did pretty well. October, you saw a massive slippage in the demand at the stores. And that October weakening of demand has moved into November. People are starting to shop sales and promotions. People are more focused on necessities than they are discretionary. I'm not making this up. They also had, I want to say the number was $400 million of theft, which they're attributing to not the lonely soul who needs to feed their kid, which is a lot of what we read on Twitter, but it's organized crime, and it's organized crime stealing things and selling them online in competition with Target. I think we should crack down on organized crime. I think that's bad, right? But that's just part of the story, right? More theft could be because of softer economy. More theft could just be because we've defunded the police. The growth on Target. So Target is focused on growth. However, they're going to cut costs by $2 to $3 billion. We're going to grow. We have too much inventory. Margins are down. Theft is up. People are shopping non-discretionary items. They're buying sales. So we're going to cut $2 to $3 billion out of our cost structure. Now, what they're saying is this is not cost takeout. This is removing some of the scale that was invested in the business because the scale, the demand isn't there. And so you can cut. I think it's great. A lot of process work, a lot of IT work. All right, we'll see. But whenever I hear of shrinking margins, increased theft, and now I see cost cutting, I think that's not a really bullish story. So if you take a look at Target's numbers, this is their earnings release. Let's see if any of that news that came out in the earnings call, really pops here. So the one is earnings per share is down 49.3%. Unadjusted GAAP earnings, yeah, I got it, down half. In the latter weeks of the quarter, sales and profit trends softened meaningfully, with guest shopping behavior increasingly impacted by inflation, rising interest rates, and economic uncertainty. Okay, that's what I'm talking about. Economic uncertainty. People are nervous. Fourth quarter operating margin rate of 3%. So now we're in like grocery store levels. 3% margin on a retailer. Now that's tough because Target always struck me as being high profit, high growth, exciting retailer where people go and they spend more money than they need to because of the experience, because of the sense that there's an entry-level price point for a category, and then there's price points above that, so you can buy the lowest entry point or you can buy higher. And so people are buying the entry point. That's what we heard. What else? Interest expense is up. Higher long-term debt, higher commercial paper balances. So interest rates are higher. Dividends. They paid $500 million in dividends. They increased the dividend. That's nice. Profits half. Dividends are up by 10%. All right. Maybe more. Return on invested capital of 14.6% versus 31.33% last year, trailing 12 months, year versus year. And the other thing I don't see in here is theft, but maybe it's in the financials. It's hard. It's a tough one, right? Because theft hurts, right? Theft really hurts, and so. Let's see if there's theft in here. I'd like to see a number, right? Theft or shrinkage. Inventory shrink. Higher markdown rates. Inventory shrink. Merchandise and freight costs. All right, that's good enough for me. It's good enough for me. So, Target's rough. What else is going on? We also saw the Federal Reserve release some data. This was out this morning. This was actually really important. How are we doing in the United States? By the way, I hope you like the hat. I got my hair cut yesterday. I hope you like that. I'm really working hard for you. You, our viewer. I say viewer because probably only one of you is going to watch this video. Other than me, I'm going to watch it. So, number one, I'll watch it. Number two, hopefully you'll watch it. By the way, if you like the video, hit the subscribe button, maybe share the link. I'm trying to share what I can. Today was a tough day. Today, I'm watching the market. First it was up, then it's down. You know, there's no real news. There's not really any. It's all negativity, you know. It's big negative Nelly out there. So I'm going to talk a little bit about it. So, but industrial production is important for the United States. And so, if you look, total index industrial production is up 3.3% for the year. Largely, the only increase was in July. August, lost. September, gained. October, lost. Between the last 3 months, the change is effectively zero. So, The previous estimate said that it went up in September, but it actually did not. So industrial production, flat. Where did it grow, though? Where's the excitement? Business equipment. Okay, so we're producing more business equipment. We're producing more mining. So mining production. And actually, rather a bit less of construction and non-industrial supplies. Okay. How about capacity utilization? I noticed that capacity itself has been shrinking. So let's say of that shrinking capacity, how are we doing? Let's see, where's the growth in capacity utilization, right? Oh yeah, where do we got it? Well, the total industry utilization fell. It's up 1.6% for the year, which is good. But you'll see in May to today, it's roughly flat. May was 80, today is 79.9, rounding error, it's 80. So there's really been no growth. Mining is higher, which is interesting. So mining capacity utilization is higher because the raw materials are worth more. Let's go to FinViz. Let's go to futures. This is not a perfect measure, but it's good enough. We take a look at silver. Silver price is up for 3 months. I bet you if I were to look for the year, silver's about flat. It was higher before, which might have driven some of that utilization. And as the prices have dropped, maybe it hasn't moved as much. Copper, prices are down. Gold's not really material, but let's stick with copper, right? So you're really looking at a price, though, that is still attractive, I believe. It went from 440, 450 to 350. Now it's up to 375. There's other things, too. There's metals, things like that, which are going to be relevant. But so it's interesting. So mining is up a little. Utilities are down, which is interesting, right? So we have over capacitated our utilities, which, if we take a look at it, we are down at pretty low level at 72%. We were running in the 80s, late 80s and the 90s, mid 90s in the 90%. And now we're running at 72.1% on utilities. So it's not a shortage. I'd like to see capacity. I saw capacity in a chart. Here it is. Industrial production capacity and utilization. So this is capacity. This is manufacturing capacity. And as you notice, in the last recession, it was pretty high right here. And it has, relatively speaking, dropped. As a nation, we have lost capacity. As a nation, we've lost production. Kind of flat. You know, COVID hit, it dropped, came back up. It hasn't really recovered. You see it here. It's a little bit higher than in like this point in 2018, you know, well before the COVID hit, 4-year view, but really flat. And so I'm struggling because you have economic growth relative to COVID and the COVID recovery, but you don't really have economic growth relative to where we were 4 years ago. Now, 4 years ago, I left the permanent workforce to start my own company. Many did the same. We felt unappreciated. We felt like the trade-off wasn't right. Raising taxes, at the time the government chastising us for making money, chastising us for working so hard. So a number of us left. Now I'm running my own business. I'm not making much money, to be honest. I'm kind of starving, but I'm having a great time. I'm learning a ton, and it looks like I'm not the only one, right? So production really is, relatively speaking, flat over 4 years. As a nation, we've maybe lost our way. Now you look at it and you think, oh, we're doing great here, right? We're up since the 60s. Of course we are. But right here in 2008, when the housing crisis hit, we kind of lost our way. And then through 2012, 2016, really from 2010, we went up a little. Maybe here's the peak, right? Like 2013, 2012. It's been flat ever since. We've never really recovered. And so without investments, oh, and here's the best part. We haven't really grown production. Utilization is lower. So our nation is producing less. We have lower utilization. We're carrying dead weight in our economy. No wonder why people are struggling. Non-durable versus durable goods. I mean, there's just all kinds of stuff here. So what I would say is this. It's probably worth a read. Do a search on Federal Reserve, industrial production, and capacity utilization. Grab the report and really look at it and see that as a nation, we really haven't moved forward. Now, we have more Facebook, more Google searches, probably online social media. I know there's more channels on the TV. You know, I got one of those little boxes from Infinity. Infinity. What's the company? Xfinity. And so as we cut our home internet prices by 75%, they gave us a free box. Let me show you what the box looks like. They sent me a second one. It's nice. I don't have two TVs, so I can't really set it up, but this is what it is. Xfinity. A little box. Do you know there's like 50... 100, 1,000, maybe 1,000 channels? Do you know I found Bloomberg TV for free? That's Bloomberg TV for free sounds great, right? You know, Bloomberg called me. What's the guy's name? Sal. Sal called me from Bloomberg. Hey, Jeff, I love your show. Love what you do. I'd like you to join up with the Bloomberg team. It's not expensive. You can have one Bloomberg terminal. It's about $20,000. No, it's more. It's about $30,000 a year. We'd be glad to have you on the team, Jeff. 30 grand, Bloomberg. And I get free TV. Now, there's all kinds of channels. I mean, there's a ton of channels. So we're not making stuff. But wow, do we have a lot of channels on TV. I think there's like a cat channel where they post cat pictures. I don't know. There's a lot of channels now. It's great. Disney, Netflix, Amazon Prime, Apple TV, you name it. And then there's all these free channels. I love it. Do you know I've watched about 3 minutes of Bloomberg TV just to make sure I had it. I've never watched it again. But that's cool, right? So we're not making stuff. So where's the steel mills? Copper, rare earth, batteries, cars, appliances, ceramics. Where's the products, the computers? Right? We don't make it anymore. We consume it. We take on debt to buy it, but we're not making it. And industrial production, turbines, construction, roads, bridges, power plants. Where are the power plants? Where's the stuff, right? And so based on this, and I haven't even gotten to the stocks yet. I got my run from this morning, from last night. I'm happy to share with you. So I'll share with you the picks and all that, but just to start it off, our federal industrial policy seems to be that we want good jobs. We want blue-collar jobs. We want jobs in this area. It seems that we want to produce more. But I don't see it. I don't see a plan. You know, we've seen this before. In World War II, I'm reading a book now that was written in 1943. Where does the money come from? Where does it come from when the war ends? And it talks about how during a war, you produce without concern over the cost of money. The money comes because you make choices. You build an infrastructure. It's so funny. I think it was Winston Churchill that said, I can't imagine building 1 million homes a year in Britain after the war. But you know, we can make 100,000 airplanes in one order. No problem. And that's in addition to tanks and guns and helmets and men and soldiers and whatever. But after the war, it's hard. After the war, we worry about the cost of money. We worry about the cost to society. Now, I would say we have a tremendous amount of slack in our economic production, and our leaders are not, they're not striking the right chord. It's ringing a little dull. So, I'm a politician. I run for local offices. I want clean water. My whole campaign is on clean water. I lost this time because I'm a Republican in a 10% Republican district. And so guess what? I won 50 or 40. No, I won like 35% of the vote, which was 3.5 times the number of registered Republicans. I did great, but I lost, right? So the bigger picture, I'd love to see an ad online that said, you know, free college if you promise to go into manufacturing. Good manufacturing jobs. Right? And we're kind of evolving away from low tech to high tech. So it's high tech, heavy industry. Let's see it. Let's build some aircraft carriers. Let's build some Arleigh Burke type cruisers. Let's build skyscrapers, bridges, airports. Let's build some stuff. I mean, come on. You know, we talk a lot about solar and wind and all of that, but I rarely ever see a wind turbine. We have like 2 in Lake County, I think. I think I saw them by a military base. Right? It's probably some government grant to study it. Let's build something, right? Let's build train tracks and trains and whatever it is that we need to build, right? And utilities, we have a lot of utility excess capacity, but I sure would like to see nuclear. I sure would like to see maybe a more efficient smart grid, whatever. And it all comes down to this. The reason I left the workforce in 2018 was I felt like I wasn't appreciated. And the talk was to raise taxes more. I remember President Obama said, you didn't do it, Jeff. I'm from Chicago, you're Chicago. You didn't do it. It wasn't you. And I thought, no, it was me. I worked a lot of hours. I lost a marriage over it. I lost everything. It really was me working all the time in different countries, leading people, and so no, it's not you. You know what? Fine. It's not me. Now, how you doing? It's not me. I'm not out there. It's not a lot of us, right? That's fine. But maybe it's not. Maybe you need to think about how do you get leadership back into American industries. So, yeah, that's important. I shouldn't be watching the stock market building financial models to make 2% in a day. I should be out running a business. There should be a business worthy to run, that makes something, that serves clients, that builds for the future. Right? Get me excited. Let's go. As opposed to, you know, Jeff, you didn't do it. Oh, and why we're going to raise your taxes again 6 times because you don't deserve the money. We're going to raise your child support payments. We're going to raise everything. You know what? We don't even like you. Why don't you go fuck yourself, Jeff? We don't like you. You make too much money. You're too rich. You're too whatever. You got a black hat. We don't like black hats, right? We like white hats. Well, here's the thing. Bring back manufacturing. Bring back industrial production. Bring back innovation in America. And I'll tell you, we'll bring back labor force participation, productivity-based wage gains, and we'll bring back economic growth. But not today. Today it's a little funny. Today it's all about internet, social media, TV, movies. It's the soft stuff. Try fighting Russia with soft stuff. You see what's happening with Ukraine, right? They had to get back on their feet. They were beaten at first, but with Western ingenuity, weaponry, material, yeah, do anything. Make stuff. So, this is where we're at. Let's take a look at the markets. Just real simple, FinViz. You can see the S&P's down, S&P 500's down a bit. You can see where. But NASDAQ's down 1.5 points. That's actually quite a bit. So let's see, where are we down? Well, regional banks are down, I think, because the economy looks soft. All of tech is down, with the exception of Oracle, Microsoft, and Motorola Solutions, and maybe some solar power company. But in general, tech is down, growth is down. Amazon and Tesla are down. Target's way down. Energy's down. Basic materials, for the most part, are down. Diagnostics are down. Integrated freight and logistics are down because of retail being down. Airlines, industrial consulting, trucking, aerospace and defense. Looks like Ukraine's going to win. Maybe we won't have to make so much. Specialty industrial machinery is down because we're really not making what we need to make. What's up? McDonald's. That's nice. Credit card companies. So people are borrowing money to eat at McDonald's. That's where we're at today. Or maybe go to Home Depot and Lowe's, buy some stuff to fix their house. Maybe paint it so you don't have to buy a new house. Fix something. And you need toilet paper. Procter & Gamble. Kimberly-Clark. Definitely need toilet paper. Maybe something to brush your teeth. The basics, right? General Mills. This is what's hot today. Walmart, Pepsi. I don't know. Not feeling it. Not feeling it. So let's take a look. Where are we at? By the way, I'm working on a brochure. God, is it painful. I do not like working on a brochure. I've been working on this thing for a really long time, and it bores me to tears. But I don't have employees right now, so I have to do it. I have to make the brochure. I don't want to make a brochure. I hate making brochures. Total crap. But I will. It's going to be about 50 pages to comply with all the requirements. It's going to be great. I wish I could spend all day on that, like for a week. So let's take a look at the run, right? Because this is something we do like to do. A down run, these are stocks that lose money. Companies that lose money listed in the U.S. 685 of them. That number's increasing. The number's increasing. So what does that mean? Well, Jeffrey, it means that we have a problem because more and more companies losing money. The variance of those stock prices keeps rising. 7.8 times 10 to the negative 4. It's pretty high. I think it was 7.6 last time we looked. Same dog stocks at the top of the list, which is interesting because it just says maybe they've kind of... Desktop Metals has kind of rescued itself a little bit. Most of these are biotech. I mean, like a lot. You have Bohr Drilling. You have Everbridge. You have Snap. You have AMC, Vertex Energy. You have Grab. By the way, Grab's been up, so it's been interesting watching high velocity, high variance, low beta, lots of movement, no direction. And it's funny because they go down, our model makes a ton of money, then they go up again. Our model doesn't make a ton of money, and then they go down again, and then they go up again, and they go down again, and they go up again, right? And so these could be great day trade stocks, but truthfully, I don't know that I want to be day trading any of this crap. So stay away. It's a down pick. It's too high risk for a long-term investor. I do tell you, though, you short them enough times, you make money. Because they do go down a lot. So we look at our up run. This is our S&P 500 up run. This is normal, standard. It's what I call the no bullshit run. We're kind of messing around with the QQQ run. We're adding some features. And so this is like our standard tried and true. And so the good news is we got all of our foreign stocks out. We're looking real clean. 1,527 profitable U.S. listed companies traded yesterday. With a minimum amount of trading, a minimum amount of market cap, $400 million. Positive beta, so they're not weird. 2.6 times 10 to the negative 4 variance versus 7.8. You should do the math and you should think 3 to 1. There's 1/3 the risk in investing in profitable companies than in unprofitable companies. 1/3 the price variance. That alone is worth watching the whole video, right? That's a big deal. Where are we at? Top stocks in the model, if you can only hold one stock, S&P, QQQ, SHI, and IWM. And gold. And there's a couple stocks in there. But in general, your best stocks are your indexes. That's why there are indexes, right? And you look, there's other stuff. It's very interesting data. These are your high beta stocks. You know, you get used to seeing these, right? These things move. When the market goes up, you really want to be in these stocks. If you could somehow figure out when the market was going to go up, you'd want to be in these stocks. If you knew the market was going to go down, you don't want to be in these stocks. That's just the way it is, right? Low beta, no movement. TLT is the lowest beta. It's effectively 0, along with the SHI. So you look at money and you look at gold, and those are the lowest beta or the lowest correlations to equities right now over the past year. So when your broker or your investment advisor says, so you need a little diversification, maybe you should buy some bonds or some gold, they're not wrong. It may not be the most efficient, most effective way to diversify, but it's pretty damn good. Because there's almost no correlation right now with the equities markets. Whether it's the long bond, the short bond, or physical gold, there's very little correlation in the markets. You are safer when you buy those. By the way, you want to move up the curve a little bit, get a little bit more correlation, but not much, without risk to a specific company. Oil, USO, there's an oil ETF there. Silver, it's a 1/3 correlation. SLV, it's not bad. I mean, there's some options there for you, right? I mean, and then we look at what our model ran. Good news is we've jacked it up to make them run just a tiny bit longer. And you're getting the best answer every single time. What I do find funny is you see these interim results, right? But in general, you don't worry about the interim results. Focus on the answer. The answer is it's 10 stocks. 10 stocks will get you a nice edge in this market. By the way, if you really want the 10 stock options, the 2 of them, you can make it 11 stocks because it's one different. So you get 11 stocks. You get a ton of good risk versus return. Yeah. We run this all the time. These are the 11. You go long this 11 equally, you're going to beat the market. At least that's the objective of our model. There's no guarantee of performance. Who knows whether you're going to make money or not? But that's what we're selling. We're selling that we can go through 1,527 stocks. We can find things that are interesting about individual stocks, but it's when you put them together pretty efficiently every day. Put them together. Here's your 10 or 11 stocks. Go ahead and buy it. And then if you want, hedge. We hedge. We either short the market or we short the dog stocks, the down stocks. And that model makes money all the time. Now I'm not going to say it makes money all the time. It makes money some of the time. It's pretty good. It's not perfect though. So we're still doing the accounting to figure out how to chart it out for you. So now you look at QQQ and the variance here is 4. 4.0 times 10 to the negative 4. Remember 2.6 for profitable stocks, 7.8 for stocks that don't make a profit. This is 4.0 for the QQQ. So it's in the middle. There must be a lot of not profitable stocks in the QQQ. Makes sense. It's tech. We're betting on futures here. Got a couple of stocks that we found because we added some things. We took this list. Remember it was like 1527. Now we're at 1556. So we added 29 stocks because I thought to myself, a company that is only very, very, very tinily unprofitable shouldn't get dinged. Let's soften it up a little, right? So what we said was, if it's a company that had 10 million loss or less, or made money, put it in. So allowing a company to take a $10 million loss adds 29 companies. It's not so bad. The risk is the same. What's interesting is when you're doing it against the QQQ, you do get different answers. The QQQ requires you to have larger portfolios. 15 stocks. Yeah. Regardless of the model, 15 stocks. What's interesting here is you can get half the bennies from a 4-stock portfolio of QQQ, SPY, SHI, and TXN. And if I look, who is TXN? Hang on, give me a second. Don't want to get it wrong. I have a feeling who it is. TXN. Texas Instruments. Wow, is that crazy? You can buy QQQ, 1 to 3 year bonds, the Spider, and Texas Instruments, and you will get half the alpha. You know, we might just have to have a cheaper version of the fund that does that. Wow, half the alpha. 4 stocks. Wrap this up. But it's not what we're doing. And so if you look at these that are all within 1 or 2 ticks of each other, it's 15, 16, or 17 stocks. Largely consistent holdings. Do you include Intuit or not? No, they all have Intuit. Google. Do you include Google or not? That's a difference. MXL or not? Although pretty consistently in. Rocket's always in. Tesla's always in. Pretty consistent. There's a couple of just MPWR made it. MXL made it. Google made it into a few. So 15 to 17 stocks when you run it against QQQ and you added 29 stocks that might have lost a little bit of money. By the way, none of those stocks are the stocks that might have lost money. All you really did was clog up your run. But that's okay. So this is the answer. So the answer is you either hold 15 to 17 stocks and you hedge it, or you hold 10 or 11 stocks and you hedge it. And you get your best risk return And if you really want to just play it simple, you do a little bit of a index strategy, and you can wrap that up too. It's kind of nice if you want to do that. And so that's what our model says, right? This is the business that we're in. And so if you like it, give us a call. We're easy to reach. www.chicagoquantum.com. Registered investment advisors. Tell you all about us. You can check us on FINRA. See the brochure. You can actually just ask if you want a newsletter and updates. You give your email, and I think what you can do is you can say whether you want to talk to us or not, or you click on this and you go to contact. Scroll down a little bit. There's our brokerage check, phone number, my personal cell phone number, and my personal email. And so we'd be glad to talk to you. We'd be glad to run a run for you, maybe get you one for free if you want, or something. Share something with you to get you excited, and bring in the family. So that'd be great. All right, I want to thank you for watching. Appreciate it. I appreciate you spending the time. And if there's anything we can do for you, let us know. Again, we're not paid to make the videos. We do it to try to benefit you, to try to explain what we're thinking, sometimes to rant, which is fine. If you like it, hit subscribe, maybe drop a few comments, maybe share the link, let people know. And again, have a great day. Good luck in the markets. You take care now. Bye-bye.